Today we're going to go through another trading strategy that you absolutely need to learn. This belongs in every chart analysis. Not only that, it's incredibly reliable. I'm going to show you so many examples, not just with Bitcoin and Ethereum. This really works with any asset. We'll also take a look at Solana, but you can also use this with gold or whatever else you trade. It works just the same. Most of the time you'll get incredibly good sniper entries with this. That means entries that are almost on point and not when the price is stalling, but when the price is in a correction. I've already made 2 videos about this, one in a scalping version. I've also explained the tool itself once. Today, we'll quickly summarize the explanation again so that you understand in this video why it works so well. And you'll see that it works on every time frame. You can use it on the 1-minute chart, 5-minute chart, 1 hour, 4-hour daily chart, anywhere. You'll simply see in the example that this exact strategy and tool really has its place. And the good thing is, if this has ever happened to you, or maybe it's happening to you right now, for example, if you bought into the Bitcoin hype up here because you thought Bitcoin wouldn't correct anymore, and then Bitcoin dropped again. Let's take a look at Ethereum. It's the same with Ethereum. Extreme hype. Ethereum, for example, has seen an 83% price increase since this low right here. This strategy will protect you in the future so that you don't end up being one of those people, or maybe no longer one of those people who buy into the hype at the top just because so many influencers are saying, hey, Ethereum is almost at 4,000. You have to buy now. And that message was spreading like crazy on social media, even though Ethereum has already risen nearly 90% from this low here. No, that's when you wait for a correction. So where are the good entry points? And I'll show you that now on the screen monitoring. I'm now on the Bitcoin daily chart, but we'll also go through a few other coins. You can apply this to any other asset as well, but I want to show you now what we need for this strategy, and I'll also show you a few examples with both Bitcoin and Ethereum to demonstrate how reliably it works. We'll stick with the daily chart for now, but I'll also show you the 1-hour chart, 4-hour chart, and even the 1-minute chart if you like, so you can see just how well this works. What do we use? It's important for you to know what swing high and swing low points are, and it's really important that you can identify them. If you don't know how to do this yet, or maybe don't have the experience to analyze it yourself on the chart, I can recommend an indicator for you. Of course, there are several swing high and swing low indicators, but I suggest Swing Levels and Liquidity by Leviathan. If you use this one, it shows you very clearly with these points, when we make new lower lows and when we have a new high. And this is really ideal to use together with our second tool, which is the Fibonacci Retracement. I've prepared an optimized version for you here. As a small example, we always draw the Fibonacci retracement from a swing low, which in this case is our last green point, to our next swing high. And how would you apply a Fibonacci retracement? This is now the optimized version. I'll show you in a moment how to do that. But I'll also explain to you in detail how this works and why it works so reliably so that you understand the Fibonacci retracement. I'll give you a quick 1-minute summary, maybe so you also understand, hey, that's why the Fibonacci retracement has its justification for existence. And in this case, since our first red dot appears here, we would now have the opportunity to enter at $79,050 or at 74,321. Of course, I'll also provide you with a stop loss strategy, or rather a complete risk reward strategy. So now the price hasn't corrected downward. What do we do then? We keep extending the Fibonacci each time until we get the next red dot and it still hasn't corrected. Okay, but that's what we did here now. And what happened then? I want to show that now. In this case, we were at $109,000 when people said Bitcoin would never fall again. From now on, we're only going up. There was hype and a lot of people blindly jumped in at the top. But what actually happened? And that's what I want to show you now. We actually hit the 0.5 and 0.618 Fibonacci levels perfectly here, and only then did we make a new all-time high. As a small example, just so you can see it again, we also had that during this correction here. We could apply that here and here as well. Then you can also see here what happened. We had a massive surge from $38,000 to $73,000, and in fact, we corrected back down to $49,000. What did that show us again? Where did we have very good entries in this case for spot buys or possible long positions? 0.5 Fibonacci, 0.618. And maybe looking back in the past, we had the same example here as well. We had a massive surge. Yes, of course, that was a very long time ago. But if we go into this low here and include this high here, and we had this massive dump, I think it speaks for itself that the 0.5 Fibonacci, as you can see here, how strongly the candles bounced off here, even a bit further down, definitely has its justification. But if you thought, hey, no, I don't dare to get in here, we're in a bear market. No problem. What did I say? We have a new swing low here. And where did new swing highs form? Just as a small example now. Of course, we'll also go through this on the short side. We had it here once, then we had it here, and then we let it run. And where did we have the perfect entry at the 0.5 Fibonacci before we reached the new all-time high? Just as a small example for you now. Now I want to show you how a Fibonacci retracement is structured. I'll quickly go into the chart so there's a bit of a black background, and now I'll do it just like you would when you draw the Fibonacci. This is how it would appear on your chart, and it would look exactly like this. It's a bit confusing with a lot of colors and so on. Of course you can leave it like this, but there are some levels that aren't really relevant to you. For that, I'll go back into the settings and, just as a brief explanation beforehand, this will only take a moment, show you why this Fibonacci tool is justified in its existence. First of all, I'll move the values to the right and for the levels instead of the values, though we'll get to that in just a moment. Maybe I'll draw this out for you again so we can say we had this little example here and also here before we have this correction so you can see why this is just as valid. And now we have here 0236. I'll also make this a bit bigger for a moment. Then 0382, 050, 618, 0786. A lot of people don't know what that means. But with the Fibonacci retracement, you can simply change the settings so that instead of using values, you use percents. And the good thing is, now it's much easier for me to explain why it has its justification for existing. When we're in an uptrend and waiting for a correction for a new entry at the 0236 level, there's a 23.6% chance of getting a reversal and continuing to rise. And at the 0382 level, there's a 38.2% chance of getting a reversal and moving up. And the truly valid zones are actually from 05 to 0786, with 05 and 0681 being among the most valid reversal zones in Fibonacci. And I think it's now very, very clear that here, for the very first time, we have a 50% chance, a true 50-50 chance of getting a reversal here and the price continuing to rise. And at 0681, there's a 61.8% chance. So an even higher chance to get a reversal and for the price to rise. And I think based on these percentages, it should now be clear to you why this has its justification. And we'll now apply this to different charts, but also to different assets, so that you understand it works in every time frame. How do I set this up so you can see how it was for me earlier? I've now saved it. Take a screenshot here, then you can see what I actually activated. I haven't activated anything else except the 05, 0786, 0681, the 1 and the 0. 0 is green, 1 is red, 05, 0681 is white. And here I've added a kind of blue, and down here I've also made the shadow, the background, a bit lighter. And now, of course, I have it much clearer on the chart here and can incorporate it into my strategy. Let's take another look at this with Ethereum. I also want to show you this bull market with Ethereum again. After this pump, no one really thought about how far Ethereum would drop again or where our new entry point might be after this pump in case we go down. As a small example, we take this swing low point, and as I said, the last swing low point we have, we can use that and draw the Fibonacci up to the next high point here, which would be red. And if the price doesn't go down to the 0.5 level, we simply keep extending it up to the next high point. And what actually happened then? No one thought anymore at 2878 that we would actually go down again. And look at what happened. Right at the 0.5 Fibonacci, at the 50% reversal chance, we actually had the almost perfect sniper entry before Ethereum then, if we take this example, went up by about, 85%. So that's incredible. And you can do exactly the same thing on the minute chart, the hourly chart, and so on. But so far, I've only shown bullish scenarios. Of course, I also want to show this from a bearish perspective. For example, if we see here that we're forming new lower lows and the high is no longer getting higher. And in this case, it didn't show this last low point here. That means you should also have a bit of price action knowledge here. But in this case, we know that this was our last low, yes, from our price action. So we make a high, go down again, make a new high, go down again, new high, go down. And this high here was no longer broken and we made a new low. What could you do now? Or what would be the ideal scenario here? Now we draw the Fibonacci retracement in a bearish direction. That means we don't pull it like before from our low point to the high point because we're not making a new higher high, but instead we're making new lower lows. So now I go in here and pull it from up here. At first, of course, you have to adjust it as you go till a new low point is reached here, and then we wait. Where are our limit orders placed? You can place limit orders here. The 0.5 and 0.618 levels were triggered, and what happened? We continued to move downward. A possible take profit point is always the 0 level again. then you would have closed a short-term trade, and if the next low point comes just as it did here with a candle close, you could of course do it here as well, but then you take the last high again. I also want to show you an example here now. Here was the last low. And what happened? We went back up again, once more reaching the 0.618, but also the 0.5, and then we broke through our 0 point to the downside and collected the next take profit. What I'm not showing here now is that, for example, we had our last high here and our last low here. That means, as you can see here, after the structure break to the downside, we had the last high here. What did we have? Again, we went into the 0.5, then broke through the 0 point to the downside again and reached another take profit. Yes. When will it happen that you say you take a stop loss? And I'll show you at the end as well, because now we have different stop loss areas with different distances. Either you always do this with low leverage or you adjust your leverage accordingly. I'll give you a table at the end of the video for that, so you can say, okay, I have a stop loss here and it's this size. I want to use this and that leverage so that I don't lose more than 2% or 1% of my trade, for example. So far, I've only shown you positive things. Let's continue here. We have a new low point. This is also continuing nicely here. New high, new low, and we didn't reach it. Here we have a new high, new low. That means we've broken this here. I'll show you this even better on the 1-minute chart, where we simply take the next highest point and what happened. We would take a stop loss here. Or if I show you this now with the trading strategy, maybe even 2 or 3 stop losses before we then catch this upward move here and take the reversal again here. But that's part of it. If you do get stopped out once, then you know, hey, now it looks like we're seeing a trend reversal. And that's exactly what happened here. But since we had a few positive trades before this, you can afford to take this stop loss. In this case, I would have said, let's maybe enter with XLP. Let's take a look at XLP on the 1-minute chart. You can see wonderful price action here, both bullish and bearish. And now we can take a look at how well these Fibonacci levels work. And this is the 1-minute chart that I have prepared here. We can see here, and the important thing is that we only enter such trades when we don't have the same high, like here, where they are at the same level. No, we only want to see a higher high during bullish price action, just like in this case. So what do you do here? We look for our last swing low. I think I don't need to explain that again, up to the last swing high. And here, the price also went down to the 0.786 level, and only then was the take profit reached. We can see that this was our last low. Again, this is the 1-minute chart. Where did it signal for us then? Our last swing high was here in this case. You had to be a bit patient here, but again, the 0.5 and 0.618 levels were triggered. But you can also, at the same time, if we see a structure break into a bearish zone, include that as well. You can hedge on your exchange, meaning you can go long and short at the same time. If you now see and believe that we're coming down here to reach the 0.5 Fibonacci level, you can at the same time, since we formed a new low here, say, okay, my long position is waiting to be picked up down here. But in this case, while one position is waiting, I use this swing high to this new low that was formed here, since we broke through this structure to the downside, to take a small short position as well. You can see it here. The 0.5 was reached and then it continued further down. While I was waiting for the 0.5 to be triggered, I could have taken a short position here, and at the same time I also entered a long position, which is of course ultimately brilliant for scalping. And you can actually keep doing this the whole time. Any time frame, it works again and again if you mark it out. Swing high, swing low, swing high, swing low. The only thing you need to be careful about is that if you always use the same leverage, sometimes you'll have a stop loss like we're about to set. That might only be, since we're doing this on the 1-minute chart, about 0.13%. Or depending on where we are, it could also be that you have a stop loss that's 0.18% here, but that's only on the 1-minute chart. If we look at this on the 15-minute chart, since we have different Fibonacci levels, we also have different stop loss sizes, and you need to adjust that with leverage accordingly. Because here in the 15-minute chart, if I go in here, we have a small structure break into 0.5, and then it continued to go down. But what happens if the market moves against us? And that's what we're going to look at now with the possible strategy of setting a stop loss. Because now we know we have the 0.5 as the entry point, the 0.618, or as a real worst case, if you want to go that far, the 0.786. And now we'll go through that in detail. So one option is to always set your risk management to a risk-reward ratio of 1:1. But that's not necessarily recommended. That means if you enter at the 0.5 here, and this is my take profit target, and this here is my stop loss, then I always have a risk-reward ratio, which of course needs to be adjusted precisely, of 1:1. But a 1:1 ratio is not a good risk-reward ratio. because you have to be profitable more than 50% of the time, minus the fees, and if you lose, actually even a bit more. And that's not optimal. But how can we avoid having a 1-to-1 risk-reward ratio without entering 3 times and maybe ending up with a position 3 times as large, which could then hit the stop loss later? No, we don't do that. Option 1, which we're going to use now. Here we have the 0.5 entry, and just before the 0.6, this is something I took from the SK system, we use a multi-stage trade entry phase. Here we actually use a 0.37% stop loss, but down here is my take profit, giving us a risk-reward ratio of 4.5. But if I always risk the same amount of my portfolio based on a leverage calculation and say I really only want to risk 1% of my trade here, I can of course adjust my leverage accordingly since we have a 0.37% stop loss here. But I have the opportunity to win 4.5 times that amount here. That means 4.5% on the trade. But what happens if we hit the stop loss? Then you have the following option. You enter again at the 0.618 level. But in this case, we don't adjust the stop loss again. Instead, we take the predetermined stop loss from the 0.5 level and apply the same one to the 0.618 level. Why? Because with this strategy, we would now have a higher risk-reward ratio of 5.36 instead of 4.5. This means that if the price then reverses here and goes down, we recover our previous stop loss and still make 4.5 times our risk, just like we would have at the 0.5 Fibonacci level. Another option would be to risk yet another trade at 0.786. But that really starts to get into higher risk as we would be taking 3 stop losses. You can also adjust your stop loss here, in this case above the next high where we had it before. For example, I see here that we had an order block. It often happens that the price moves into an order block and then goes back down. But here too, please make sure to adjust your leverage accordingly. Don't risk too much because the stop loss is no longer 0.38%, but double that, 0.74%. That means with the same leverage, you would have double the risk. But for that, let's take a look at the leverage table now. And what also makes sense, of course, is to protect yourself with a stop loss and at some point move it to break even. But when would that be? In the SK system itself, there's a rule for this and I find it very, very interesting. It's simply when the risk reward has reached 1 to 2. What does that mean? If we have our stop loss here and for example entered at the 0.786 level, or let's take this example here. We entered here, our stop loss was here. And down there is our price target and we can see it was triggered down there. But when do I move my stop loss to break even? And if I see here, okay, this is our stop loss and I've already reached a 1 to 2 risk reward, as you can see here, then I move my stop loss to break even and my position is at least secured. So I can't take a loss anymore. Because of course it can happen that we get a reversal. It also doesn't make sense for you to have already been in profit and then still get stopped out. No, because it will also occasionally happen that the price goes down here, doesn't reach the take profit, and then maybe triggers the 0.618 again, and only then goes back down. And this way, you exit at break even here, open a new position at 0.618, and then continue downwards. To wrap up, let's go through risk management in detail again, specifically regarding leverage, the adjustable leverage that you have. The point is, if you say you have a $10,000 account and here you have 0.38% and you only want to risk 1 or 2% of your $10,000. I now have a list with 2% and here I am at 0.38. That means if we're more at 0.4 here, I could use a 50x leverage to include this 0.38% here in order to lose 2% of the portfolio. But if you say, and that's what I would actually recommend, 2% is a bit much, it's better to go with 1%. So take a screenshot here and you can see 2% per trade from the account, but maybe do it with 1% or even 0.5% instead. That means depending on how much percent you want to risk, you simply have the leverage, for example. That means if I only want to risk 1% of the 0.38%, then you just use a 25x leverage here. But if you only want to risk 0.5% of your total capital, then you use just 12.5x or a 12x leverage. Under no circumstances should you trade with unnecessarily high leverage because you will have different stop loss sizes, as I mentioned earlier. There will be situations where we don't have 0.38%, but maybe, as we see here, from 0.5 to 0.618, that's, for example, a distance of 0.66 or 0.63% that we have. And in that case, I don't want to go in with the same high leverage. No, I can use the table. I know that here I have a distance of 0.63%. Then I see, okay, 0.6%, I'll always take a little less, would be 33x leverage if I want to risk 2% of my total account capital, or 16x if I only want to risk 1% here. Or an 8x leverage if you halve it again if I only want to risk 0.5% of my total capital. I hope you understand what I mean. 2% of your total capital, not of the trade. But if you say you're taking $1,000 per trade here, so 10% of your total capital, and putting that into a single trade, then you can use these leverages here if you want to lose 2%. But if you only want to lose 1%, you have these leverages. And if you only want to lose 0.5%, please have it once more. It is absolutely not advisable to trade with high leverage. Don't forget, trading is always risky. A total loss can happen very, very quickly. With that in mind, I'd appreciate it if you subscribe to this channel, maybe left a like under this video and dropped a comment. Also, check out my trading bot tutorials that I have here in the playlists. Yes, we're making really great profits with it in the community. You can easily set it up yourself on the Bitget exchange, but also on Bitunix, and you can generate passive income here if you use it correctly. So take a detailed look at it and I'll see you next time. Ciao, ciao.